Simplilearn. Your pace, your place.
Financial Risk Manager, FRM. Part 1 of the FRM exam covers the fundamental tools and techniques used in risk management and the theories that underlie their use. Commodity forwards and futures. Welcome to the 33rd session in your preparation for the FRM Part 1 exam. In previous sessions, we have introduced you to commodity markets and commodity futures. We will now discuss these in more detail. The next two sessions are devoted only to the commodity spot and futures markets. In this session, we will learn about the basics of commodity markets and the risks involved. In the next session, we will focus more on the commodity futures. Agenda. The prime agenda of discussion will be learning the basics of commodity spot and futures markets. We will first introduce you to the spot, forward and futures markets. We have already learned about these in previous sessions when we discussed stock markets. The commodity spot, forwards and futures markets are similar. We will then learn about the market participants in commodity markets, which include hedgers, arbiters, and speculators. The risks involved in commodity markets will also be discussed. These include price risk, transportation risk, basis risk, delivery risk, and credit risk. We will finally discuss about settlement and alternative settlement methods. Spot, forwards, and futures. Let us begin our discussion by quickly reviewing the distinction between the spot, forwards, and futures markets. In spot markets, the price is quoted for immediate delivery. That is, as soon as the price is paid, the commodity is delivered at the spot price to the buyer. In the forwards markets, the traders enter into a contract to buy or sell the commodity on a future date at the agreed price. The delivery takes place on the future date, which is also called the expiry of the contract. The seller of the forward contract has to deliver the commodity to the buyer of the contract on this date. A forward market is a one-to-one market and is not regulated by any exchange. In a futures market, the procedure for contracts is standardized, and there are specific requirements by the exchange that must be fulfilled by both the buyer and the seller of the contract. The exchange also acts